Hi, this is TJ with netpicks.com, and I'm here to talk to you today about the Ultimate Trade Analyzer. Today I want to cover a brief discussion about two very important statistics called expectancy and expectation. It's easy to confuse the two and to think that they're both the same, but they're actually two very different pieces of information. Let's start with expectancy. Think of expectancy like this. It's a dollar amount based upon the probability of winners or losers and the average amount in dollars won or lost. In other words, it is the average amount you could expect to win or lose on every trade. Think of it as the average dollars per trade. So if you've got a bunch of trades, for instance, the example I'm showing you in this video, there's 650 trades, and there are a few different equations that you can use to come up with what that expectancy number is, but the simplest way is to just take your net profit, in this case $71,920, and divide that by your number of trades, and that's going to give you your average dollar per trade, and that's shown right over here. It's your dollars per trade. So your average dollars per trade is $110.65. So your expectancy is $110.65. In other words, based on the data in this study, based on the 650 trades, your expectancy is to make $110.65 on average per every trade you take. Now some trades will make more, some trades will make less, some trades will lose, but the average that you will make per trade is $110.65. That's pretty good expectancy. So how does that compare to expectation? Expectation can be thought of like this. Expectation is the mathematically provable probability that a system will end up with profits, not losses. It's really referring to the system itself, not the expectancy of what you can make on a given trade. That's the difference. So a trading system with an expectation greater than 0 is a positive expectation trading system. In other words, it is expected to make money. As expectation gets larger, the underlying statistics of the system are stronger. And the Ultimate Trade Analyzer comes with this very nifty expectation tool. But you have to know how to use it and what it means for you in your trading. We've already discussed how easy it is to determine your expectancy, the average dollars you could expect to make on any given trade. Now we want to make sure that our trade system is stable and expected to make money into the future. It's a completely different analytical number, a completely different analytical tool. What we need to do is we need to determine the average dollars won divided by the average dollars lost, and that's shown here in this cell B10. And we have to also compare that to the winning percentage. Once we have those two numbers, we can flip over to our expectation table and you will see this. What you're looking for is an expectation as close to the green or as far away from the red zone as possible. So you line up your average dollars won divided by your average dollars lost, 1.1 in this case, and you come all the way over to the right until you get to your winning percentage, which is along the top here. And that brings us to this number right here, 0.47. So we're just bordering the green zone. Anything over 0.5 will end up in the green zone. This is actually very good because there's a lot of wiggle room. If the system gets into any sort of trouble and drawdown, you're going to tick down a little bit. You're going to have to go down quite a bit before it gets into the red zone. And it won't take much to push it into the green zone. One good winning streak, for example. A lot of times I'm asked the question, well, how do you know when it's time to ditch a system? How do you know if the system is just going through a tough patch or if it's actually falling apart and will continue to lose money? One thing you can do is keep your eye on this expectation table, because as the system begins to degrade or the performance tends to go down, the expectancy will little by little start moving either closer to the red horizontally if the winning percentage drops, or vertically if your average dollars won versus your average dollars lost goes down. So those two pieces of information we're keeping an eye on here with this table, and as you get closer and closer to the red, well, the red flag should go up and warn you that perhaps it is time to start making a serious change with your trade system. So the expectation table is very, very important to your trading. You should always keep your eye on it. There's a lot of great information pertaining to expectancy and expectation. Do a Google search and read up on it. The more you know about these two very important statistics, the better off you will be. The most important thing is knowing how to use the information to help your trading. It's very easy to see with the Ultimate Trade Analyzer that the average dollars you're making per trade is green or red, positive or negative. And it's easy to see on the expectation table whether your expectation of the system making money in the future is positive or negative. Thanks for joining me on this brief video. This is TJ with netpicks.com, and I'll see you on the next one.